Hello and welcome to the KE Report. I'm your host, Shad Markwitz, and I'm speaking today with Jordan Roy-Byrne, founder and editor of The Daily Gold. We'll put a link to thedailygold.com down below this so you can follow along with Jordan's work. And Jordan, it's great to get you on the call again, like we do each week, just to look at the technical setup in the metals and the markets, some of the intermarket analysis, some of the ideas that you're sharing with subscribers. And let's start with gold. Gold has continued to have a loftier level here in the 2180s, and it's dipped down earlier in the week, had a little bit of a corrective move. That didn't surprise people because it was getting a little overbought the end of last week. But a lot of people are wondering, is there more juice to squeeze here? Can gold keep running in the near term, or do you feel it needs to rest before the next leg higher?
Yeah, I think there's definitely more juice in the near term. I mean, potentially a lot more juice. Although, if we're looking at the last couple days, yes, there's some resistance at 2200. That's a very short-term resistance. You look at the move in silver today, that's a really good sign. I mean, that should imply for gold and the sector as a whole that the short-term trend should still be higher. Yeah, I mean, the miners before today, I mean, they kind of corrected for 2, 3 days or so. And when you're in really strong trends, that's the kind of correction that can happen. Whereas it's so small, it doesn't really go that deep, or maybe you just have a sharp sell-off for one day and that's all that happens. So again, I don't have a super strong opinion on the very short term, but gun to my head, I would say the action in the miners today and silver, that's telling you that gold is probably going to break 2200 in the next couple of days. And so referring back to the targets I mentioned last week, you have 2350 and then you have 2500. So if gold clears 2200 convincingly, maybe it's going to run up to 2350 before it pulls back for a couple weeks. So I know it's really difficult when you're coming off a significant bottom. I mean, even when you're coming off a significant bottom and you have a major breakout, the psychology is market has run too far too fast. I can't buy it here. But, if we step back, we just had this historic breakout in gold. This is really significant. There's not going to be a big correction anytime soon. And it's hard to say, but you got to be a buyer at this point.
Well, Jordan, I think that brings up a larger point, and we were talking a little bit about this last week, but it's basically switching people's psychology from a bear market playbook to a bull market playbook. And to the point you just made, in a bull market, when things really start breaking out, the pullbacks are going to be more shallow than people are used to. They're used to the bear market pullbacks that go further down than they're used to and get way more oversold than they're expecting. But in a bull market, maybe just break down for folks the psychological change they have to make when they're looking at the charts and looking at indicators that maybe the pullbacks aren't as steep and they don't last as long as people are expecting.
Yeah, the psychological change is exactly what you said. Is pullbacks, they tend to not last as long. They won't be as deep. At certain points, the pullbacks can be really swift and sharp, where sometimes if you think about maybe a junior that's been really strong, like maybe it corrects 15% over 2 or 3 days, and that's it. You missed it. You're waiting for some 30% like perfect buying opportunity. It's just not going to happen. Now, in a larger sense, like if you look at RSI, I'm not a fan of momentum indicators because they're just derivatives of price. But the RSI, in my opinion, is the best one. And so when you're looking at you can look at a daily chart or even an hourly chart. And what you initially learn is the RSI, which goes from 0 to 100, 70 is overbought, 30 is oversold. But when you're in like a bear market, it can go from 10 or 20 up to 50. But when you're in a bull market, like we're probably in now and going into, instead of 30 to 70, like you can see 40 to 80 or 50 to 90 on that indicator. So you have to shift the parameters of what is overbought and what is oversold. Now, at the same time, that doesn't mean, you immediately want to jump into something that's just gone straight up. I mean, that can, maybe it can digest for a couple of days or a week or two. You got to use common sense, but you have to adjust the parameters that you've had in recent years. Like you were saying, overbought. I mean, what is overbought is going to be way more overbought that you thought 3 or 6 months ago, or even 2 or 3 years ago. At some point, we have to look at breadth indicators and assess okay, maybe the miners have gone too far. They're going to have a pullback for a couple months, but I don't think we're at that point. I mean, you have to look at technical resistance on the chart, but more so, you have to look at breadth indicators to show you when the buying is really exhausted and there will be a rest. But again, when you're transitioning from a bear mindset into a bull mindset, and this is true with all markets. I mean, the market can just stay overbought for a long time and it can just keep going and going. And so that's something that listeners and me as well, we need to bear that in mind because the market can remain overbought for much longer than you think.
Yeah, I think it's such an important point because a lot of people wait so long to finally see the breakout. And then as soon as things break out, they're so unused to seeing things be what would be traditionally an overbought indicator on a chart that they sell too early. And like we've seen in things like uranium stocks or AI stocks, or look at Nvidia, look at the cryptos, things can just keep blasting higher and higher and become somewhat irrational. But it doesn't matter when there's a momentum trend underway. Things can just keep moving. So it's important to just to remember not to sell too early, or that you fail to position when there are those shallow pullbacks. One more question on gold, though, just on a technical basis, Jordan. As far as calling it a breakout, we've had a very big range of opinions on the show over the last 2 weeks. Some people said that when it finally got to 2095 that Friday on March 1st, that was the breakout because it finally broke out above the level that we had seen in the prior three peaks. Other people wanted to see a definitive close above 2100 on a daily and weekly, which we've definitely gotten in spades now. Other people wanted to see that overseas trading high of 2152 that happened in Asia that one time on Sunday night, where they wanted to see that cleared just because that was the prior intraday high. Well, that's also been cleared. But we've had another opinion shared on the show that we need to see a monthly close over 2100 for this to be considered a breakout. Have we had the breakout yet, or do we need to see that monthly close well above 2100 to confirm it?
Yeah. If we're talking about a monthly close, then we're talking about monthly prices and specifically monthly closing prices. And the monthly breakout in gold, to me, I'm looking at a monthly chart. That really occurred in November. I mean, if you look at a monthly chart, the breakout occurred in November. Then you had some consolidation for the next couple months, and now you moved a lot higher. The monthly close above 2100, that's kind of overkill to me. I mean, all the other things that you mentioned made a lot of sense. I mean, you had the daily close over 2100, the weekly close. Once we cleared 2100 and closed above it, as we've done convincingly, the market's broken out. I mean, just the monthly close at this point is overkill.
Okay, just wanted to run that by you because I agree. I think we already saw the monthly breakout in November, and then it repeated it in December, and we had the highest monthly, quarterly, and annual close in December. That's all pretty bullish action, so it looks like that's going to sustain the move here on the longer term in gold. Let's also pivot over to silver, though. Silver's got a different setup than gold. It's not nearly the same kind of chart action, but it has had a nice pop lately, and today, as we record this, it's over 25. So how are you looking at the technical setup in silver?
26 is the key level. 26 is weekly and monthly resistance. First, let's see if we can get a weekly close above 26, then a monthly close above it. I do have to say there's lots of charts floating around with trend lines and triangles in silver. Those are incorrect. I know it looks like it could be in a triangle, but if you're carefully watching the price action, it's not conforming to any of these triangles. So I would say, again, circling back, just focus on 26. And then I'm looking at the monthly, which I think the monthly resistance is around, you have 28, you have the mid 28s. But 26 is really that's the first important level on a weekly and monthly closing basis. I tend to think, and this is just a guess at this point, that silver can break 26, but maybe it gets stuck in that 26 to 29 area. That's where I think where you could see momentum slow down potentially. Now, obviously, when you get a monthly close at 29, that would tell us it can probably go to 33. I mean, there are some measured upside targets at 32, 33, even 34. I mean, if you look at silver, I know it looks like there's an inverse head and shoulders, and there is, but it's a complex, and it's the way it's developed is not as reliable as other patterns, but that does project to upside of about 34 if we get a close above 26, weekly or monthly close. So that's something to keep in mind. But essentially, to try and clarify here, 26 is the most important level, weekly and monthly. But at the same time, 28, 29, there's a lot of resistance there. So I do see breaking above 26. I see the risk that then silver could slow down at 28, 29, and maybe it goes back and forth between 26, 28, 29.
Okay, so we want to see the break above 26, but then, yeah, a big congestion zone there between 28 and 29. And there is a lot of prior peaks and trough in that area and times where it got stuck sideways there. So to see it finally punch above that, you got some targets in the low 30s that it could jump up to pretty quickly, but it's going to be tough to get through that area probably on the initial go. Well, Jordan, this brings up another discussion we were having off mic about silver having a pretty tight correlation over the last dozen years to GDX. When you look at those charts overlaid, there is a close correlation. You had made the point to me off mic that that's because it was really in a secular bear market during that time period, so those correlations are tighter. But when you look at historic analogs and you see gold really take off, that often it takes silver a while. There's a lagging effect before silver will get going, but the gold stocks will start ripping up pretty close to when gold does. And so when the gold stocks take off, we could see a divergence from what we've been used to seeing where the gold stocks start outperforming the moves in silver, at least in the medium term. Maybe unpack that idea a little further.
Yeah, now gold stocks and silver, they're both leveraged plays to gold. We know that for them to do well, they need gold to be in a bull market or have a major breakout. Those are the points after the breakouts when silver and the gold stocks, they really outperform. Again, they're leveraged to gold. And at the same time, if you're in a secular bear or a cyclical bear market, they're going to perform poorly against gold. So if you put these on a chart, they look really obvious, but there's that saying correlation is not causation. So I think when some people take it too far when they say, oh, well, the gold stocks need silver to break out. I mean, there are some historical points where gold, like the early 2000s, where silver lagged gold in its breakout, I think for a while there at the end of 2002, 2003. I mean, remember the gold stocks bottomed in November 2000. Silver didn't bottom until 12 months later, and silver really didn't get going until I want to say mid to late 2002, maybe even 2003. I mean, in early 2003, silver was still really cheap. So, if we see a market where gold goes to 2,400 and silver's only at 24 or 25, I mean, the gold stocks are going to outperform at that. You've had this $300 or $400 move in gold. I mean, the gold stocks will perform much better. So in other words, the gold stocks are leveraged to gold's performance as silver is, but at the same time, they're not, they don't need silver to do anything to outperform. And so I looked at the 6 or 7 historical breakouts in gold. And then I looked at how was silver's outperformance or nominal performance and its outperformance. Now, in a couple of these cases, it was like a month or two later, silver started outperforming gold. But I want to say like 4 of them, it took, in one case, it might have taken a year, another case, 5 or 6 months, another case, 8 months. So there is a historical precedent where gold breaks out and yes, silver performs well, but it can take a couple of quarters for silver to really begin its outperformance against gold. Now, I ran the gold stocks against gold, just expecting it to be like identical to silver, but it wasn't. When gold breaks out and starts running, the gold stocks almost immediately outperform gold from that point. So that's how I look at it. Silver and gold stocks, they're both leverage plays to gold. They need gold to do really well. And yes, over time, generally they're going to follow each other, but let's not draw a conclusion that doesn't make any sense that, gold stocks need silver to do something. They need gold to move as it's moving now, and they'll really outperform. And so that's when you could kind of see this discrepancy. If it's going to take silver 6 or 9 months to really outperform gold from this point, like you can see the gold stocks really outperform silver after this breakout. So yeah, that's the bottom line. Gold breakout, gold stocks should outperform gold first. That'll eventually be followed by silver.
And I guess we would expect that the silver stocks finally bring up the rear there because it will probably take silver breaking out along with gold and the gold stocks to really finally pull that sector along. But then usually those silver stocks have a lot of oomph to the upside, a lot of torque, and a lot of times they'll be the biggest outperformers when they finally get moving. Now, a lot of people look at silver and they throw it in the industrial metals category instead of just the precious metals category. It is a dual metal. It is a hybrid metal. And so a lot of people look at correlations between silver and copper. There's a lot of people today, Jordan, as we talk, noting that copper has popped its head up above $4 again. We were talking before the call. It doesn't necessarily mean it's a breakout in copper just because it's above $4. It is nice to see a $4 handle on the red metal, but what is your technical take on copper, and how are you looking at the chart setup?
Yeah, I mean, if you're looking at a daily chart, which I'm looking at now, or maybe a weekly chart, you are seeing a breakout there. But if you're looking at the monthly chart or even a quarterly chart of copper, there is really stiff resistance here in the low fours, it looks like. 425-ish, that area, 430. I mean, you have resistance there on the monthly and quarterly chart. So I'm not downplaying the action in copper. It's definitely very positive. Again, if you're looking at the daily chart specifically. But if you're looking at the weekly chart, monthly and quarterly chart, like you're seeing a lot of resistance in the 425, 430 area. And so it is, again, it's a breakout on the daily chart, but it's not, I mean, even on I'm looking at the weekly chart right now, it's really got, I would say it really has to close above 430 on a weekly basis to be a weekly breakout, because it's not even a new 52-week high. I mean, it could be, but yeah, I know we're getting into the real nuances here, but that's why looking at charts on multiple time frames is really important, because if you look at gold, you can see, wow, this is a breakout on every time frame. This is a 13-year major breakout. Copper, yes, there's a little breakout here, but there's still tons of technical damage in the mid fours and a little bit below that. And so copper will have to chew through that at some point. But eventually, I will say this, and this is a bigger picture comment, because I'm looking at historical charts, 50, 100-year charts. I'm looking at gold and silver, and yes, gold's broken out. You can see where that's going. And eventually we can see silver will break 50 and have a really explosive move. And if you're looking at copper, you see the same thing in copper, where it kind of has this 15, 16-year base, depending on how you draw it, that eventually, I mean, even if it takes silver or copper another 2-3 years to break above $5, like that also has potential to be a real historic breakout. So gold making this big breakout, that's just the leader. Like, you're going to see these other commodities follow it, and copper will definitely be one. Now, in respect to silver and copper, silver's biggest moves, it follows gold, not copper. So even though silver is an industrial metal, for me, using a bird's eye view, it trades like a hated precious metal and not an industrial metal. And even, the silver supply demand in the whole industrial aspect, like, to me, that's really meaningless, because yeah, there was a supply deficit, I think, in the last couple of years, but silver didn't do anything. Like, its best years are when investment demand is off the charts and it's well supplied, actually. So that, to me, is why I view silver as almost entirely a precious metal, like a precious metal that's hated. But, generally speaking, gold leads, silver follows gold, and then copper follows silver. That's how I look at it.
Okay, well, I think we'll wrap it up there today, Jordan. Some great level-headed thoughts on all three metals, gold, silver, and copper. And gold is the leader, silver follows the leader. It acts more like a precious metal on breakouts, and eventually copper follows silver as the metals complex starts breaking out overall. So it's going to be interesting to see how the future unfolds, but it sounds like it's a pretty bullish scenario for the longer term in all three of these metals, and we'll keep our eyes on the short-term blips, and we'll check back in with you next week, Jordan, but always appreciate getting your thoughts. If people like getting Jordan's analysis, definitely click on the link below. It takes you over to the Daily Gold. You can follow along with Jordan's work. And Jordan, I may just give you a quick minute here. Maybe share with people listening, what do you provide your subscribers? What kind of analysis do you give to your subscribers when they come over to the Daily Gold?
Yeah, thanks, Shad, for the opportunity. We focus on a lot of macro technical analysis. I look at a lot of really, really long-term historical charts and macro relationships and intermarket analysis. I discuss those things, but also at the same time, the other half of the service is company analysis of junior mining companies, specifically gold and silver. I'm looking for what I like to term the highest quality juniors that have the highest amount of upside. So I'm trying to balance those two. And That's the focus. And I put out a lot of free work, as you know, but the focus in my service is half company fundamental analysis of juniors and the other half is macro technical analysis.
All right, Jordan. Well, I appreciate you reviewing that, and I think folks should definitely check out Jordan's work. At least check out his free work, and then if you feel so inclined, check out the deeper dive into the analysis he does into the markets and into the companies. I think it's well worth it, and it's definitely appreciative for us at the KE Report that you spend time with us every week, Jordan, looking at the markets. Looking forward to our next conversation.
Me too. My pleasure.